The broadcast is now starting. All attendees are in listen-only mode.
Welcome, everyone. My name is Ellen Denman. I'm a corporate trainer here at Remen Wholesale. I would like to thank everyone for taking time out of their busy days to attend the second installment in Remen Wholesale's webinar series on integrated disclosures. This webinar will be distributed after today's presentation. You can view part one in the series as well by going to our website at www.remenwholesale.com, and it is listed under resources and under the webinar section. At this time, I would like to ask a couple of poll questions. We do have a lot of people still signing on, but I will launch that. I'm going to launch the first one and give you about 30 seconds or so if you can answer that question for me. And for those still signing on, if you can answer that, I'll give you a few more seconds. Okay. I will close this one now. And I'll share the results. You can see we've got quite a good mix here of folks who are joining us. That's terrific. We do have one more poll question. How familiar are you with the integrated disclosures? And if you can just take a few moments to answer this for us. Looks like we've got a good mix also. Give you a few more moments to answer. Okay, I am going to close out the poll. We do still have some folks joining us. Okay, I'll close that and share the results with everyone. So we do have a good mix. About 57% of you are somewhat familiar, 34% this is all new to me, and 10% are very familiar. Let me hide this. Thank you all for participating. I would like to, at this time, introduce our Director of National Sales here at Remen Wholesale, Carl Markman.
Thank you very much, Ellen, and thank you very much for everyone attending today. We have more people than we anticipated on this call, probably because Ben is the one who's going to be presenting today. But I've been traveling the country, speaking to a lot of people. I see a lot of lenders out there and associations talking about TRID and about integrated disclosures. It's a very, very hot topic. The months are going to melt away until this all takes place on August 1st. So I applaud all of you for taking the time out of your day to listen and to educate yourselves. We have the former Deputy Assistant Director of Regulations at the CFPB who actually led the development of the proposed rules and forms that we're going to be discussing today, and that's Ben Olson. So I'd like to introduce Ben, who will be our speaker today.
Thanks, Carl, and hello, everyone. Thanks for joining today. And so this is part two, and we'll assume some level of familiarity with these disclosures, but in the rules that underlie them, well, also trying to cover the bases for folks who are still getting familiar. Here in a single slide, oh, those are our pictures. Okay, so here in one slide is what the new rules entail. For applications received on or after August 1st, 2015, the good faith estimate and the initial till will be replaced with the loan estimate. So no more good faith estimate, no more till. The items constituting an application are narrowed, which will require lenders to provide earlier disclosures based on more limited information. We'll talk about this in more detail, but essentially, once you receive 6 specific pieces of information, you will have 3 business days to provide the new loan estimate. That loan estimate will be subject to the tolerances originally adopted by HUD in 2010 with some changes that I'll be talking about. And they are, of course, subject to CFPB enforcement, as are the existing tolerances. But what's new is there will be a TILA private right of action for violations of the tolerance requirements. Then the HUD-1 and the final TIL will be replaced with the closing disclosure. And the initial version of this disclosure must be received 3 specific business days before closing, requiring additional work in the process. And there are different definitions of business day. That matters here, and we'll talk about it. A revised version of that closing disclosure can be provided at the actual consummation, and we'll talk about what can change in between. But perhaps most important, the lender is now responsible for errors in the settlement agent's preparation of the settlement disclosures. So that's liability for the lender, it's vendor management risk for the lender, and which is why you're seeing a number of large entities like, excuse me, Wells Fargo and Bank of America announcing publicly that they will prepare this closing disclosure. It will no longer be left to the settlement agent. Okay. A few notes on the effective date. The Bureau has stated that there is no early compliance permitted here. And what that means is you cannot just start using the loan estimate and the closing disclosure early. Instead, you have to be prepared to essentially flip the switch on this. And that means that if you have an application that's received on July 31st, then you're going to provide a GFE, you're going to provide a TIL, and you're going to close that loan with a HUD-1, no matter when it closes, as long as the application is received on or before July 31st. If you receive an application the very next day, August 1st, then you're going to disclose a loan estimate, and you're going to close that loan with a closing disclosure. This means there will be a period of time where you will be simultaneously originating loans using 2 different sets of disclosures. So it's going to require real careful diligence and strong systems, particularly during this period, because it's going to be very easy to make mistakes here. But the idea behind this was that the Bureau wanted consumers to have a consistent experience throughout the process. They had to pick a date. They picked August 1st. All right. So now we're going to talk about the loan estimate, which is where we'll replace the good faith estimate in the initial TIL, and you'll see it covers a lot of the same disclosure material with some new things and also some things removed. And we'll talk about the rules that underlie this. And as important as the forms are, and for folks on this call who are going to be sitting across the table from borrowers or discussing these forms with them over the phone, it's very important to understand how the forms work and what they're intended to accomplish and where the pitfalls are. But it's equally important to understand the rules that sit under them regarding timing, regarding tolerances, what can change, what can happen when. It's actually more of a procedural rule than it is a forms rule. And that's where most of the pitfalls will come in, is on process, not on form. So, having said that, use of the Bureau's forms is mandatory for most transactions, and only limited modifications are permitted. And we'll talk about some of those modifications. The reality is, if this is a loan subject to RESPA, it's a federally related mortgage, then the form has to look exactly like the Bureau's form. Technically, you could make some modifications if the loan is only subject to TILA, for that small sliver of loans, but in reality, investors are going to expect this to look exactly like the Bureau's form, and you're not going to want to mess with it, I think. There's one sort of overarching requirement when filling out this form, and that's that the creditor or the broker, if they're standing in shoes of the creditor, and we'll talk about that, must exercise due diligence to obtain the best information reasonably available at the time the estimate is provided. So it's not enough just to provide an estimate. What the Bureau believes a good faith estimate means that effort must be made to actually come up with an estimate that's based on the best information reasonably available. Now, you can rely on third parties for that. You can rely on real estate agent, you can rely on the consumer. The settlement agent can rely on the creditor, and the creditor can rely on the broker. That's permissible, but the point is that as you think through all the different elements of the form, it's going to be necessary to say, be able to say, this is how I arrived at the particular estimate I'm providing. Okay, so timing. The loan estimate must be delivered or placed in the mail within 3 general or open for business days after the creditor or the broker receives an application. We'll talk about the definition of application in a minute, but what matters here is that if the broker is the one in primary contact with the consumer and the broker receives the application before the creditor has even heard of this loan, then this obligation applies to the broker. And the way the rule works is the Bureau specifically says if the broker is the one taking the application, providing the loan estimate, then you read all the requirements with respect to the loan estimate in the rule where they say creditor, you read broker in their place. So there is liability here for the individual broker under this rule. Okay. So the 3 business days is the core requirement here. The existing Mortgage Disclosure Improvement Act rule of providing the initial disclosure 7 specific business days before consummation. And let's just talk about the difference between the 2 business days. When we talk about general or open for business days, we're talking about the rule stating that days on which the creditor's offices are open to the public for carrying on substantially all of its business functions, those are the days we count here. So if we're reading the broker into this, if the broker is not open for business on a Saturday, then Saturday does not count as a business day. If they are, then it does count. If they're open on Sunday, then Sunday counts. So it is tied to how your business functions. The requirement around substantially all business functions creates a lot of debate. But one way to think about this, folks tend to focus on, backroom operations. Well, what if our processors aren't here? What if our underwriters aren't here? But generally speaking, I think you need to be careful while the Bureau hasn't come out and said it. If you're taking an application from a borrower on a particular day, you're probably going to either need to assume that that's a business day or make sure you're very clear with the borrower about what's going on. I'm taking your application today, but not actually open for business, and nothing's going to happen with it for another day. Let's see. And then the 7-day rule, and really all the business day calculations that are tied to consummation of the loan, right? So you've got application counting forward 3 business days, and then a lot of timing requirements are certain things must occur a certain number of days before consummation or closing of the loan. And those days are the days that are used today for calculating business days for the rescission period. So it's going to be every single day except for Sundays and legal public holidays. And a quick note on consummation here, just in case. Hopefully that concept's familiar to this audience. It's a TILA concept, and it just means that consummation is the date on which the borrower becomes legally obligated. Generally speaking, that's going to be the date they sign the note. But it can be different than the date of closing or settlement in some states. Okay, so moving to the definition of application. It means submission, and we'll come back to the importance of the word submission. Submission of the following information for the purposes of obtaining an extension of credit. And then here you have the 6 listed items. They should look familiar: name, income, Social Security number to obtain a credit report. Importantly, that's the Social Security number, not the credit report. So once you have the number, you've fulfilled this. You don't wait for the credit report. Property address, estimate of property value, and loan amount sought. These do not have to be in writing. The borrower providing them to you orally is sufficient to trigger this requirement. But there's a question here. How does this impact leads? And so I want to talk for a moment about the language here around submission of the information for purposes of obtaining an extension of credit. The Bureau's been clear that those words have real meaning. And the fact that you get this information about the borrower, you could somehow potentially have some or all of these items. Maybe you have them already in your loan file because they're an existing customer and they've come back for a refi. Maybe you've got a lead and you've acquired some of this information that way. Those things do not trigger an application. What triggers an application is the submission of the information for purposes of obtaining an extension of credit. So the borrower didn't give it to you for the purposes of obtaining an extension of credit, but instead you got a lead from somewhere else, then that's not going to trigger this requirement. All right. Now what the Bureau said is that the creditor or the broker is not limited to collecting these 6 pieces of information. They can actually ask for anything else they want. You can't require verifying documentation. Talk about that in a moment. But the key thing is you could ask for 20 items. You could ask for 30 items of information. The key, though, is once you have these 6, the clock starts running for purposes of providing the loan estimate, and you cannot refuse to accept any of the 6. So, you know, what a lot of folks out there are planning to do is to structure their process so they're asking for the Social Security number or the property address after they get everything else they need, and that's perfectly fine, except that if for some reason you had a borrower who came in and only wanted to give you these 6 pieces of information, you can't refuse to accept them. That would be a violation of the rule. Now, if you've got a borrower who only wants to give you these 6 pieces and nothing else, that should probably set off red flags for other reasons. But nevertheless, you need to be prepared to deal with that situation because it would be a violation of the rule to tell the borrower you can't help them, you know, unless they give you additional information. It doesn't mean you have to originate the loan, but you do have to provide a loan estimate within 3 business days. Okay, so this process of an application, that's the box in the middle, and it triggers all sorts of requirements and basically transitions the process from the pre-loan estimate process to the post-loan estimate process. And so this slide is just designed to show you some of the requirements that apply before and after. So before an application, you have an application, you cannot require verifying information from the borrower as a condition of providing the loan estimate. Not until the loan estimate is provided can you start requiring verified information from the borrower. Now, that doesn't mean necessarily that you can't do you know, a pre-approval or something like that. A lot of folks will intend to deal with that by not collecting a property address. But nevertheless, what's very important is that you do not communicate that the borrower needs to give you any documentation before you will give them a loan estimate. That would violate the rule. Similarly, while you can provide pre-loan estimate worksheets or cost estimates that are specific to the consumer, it's perfectly permissible. There are 2 requirements that go along with that. One, it can't look like the loan estimate. So you can't use this loan estimate form developed by the Bureau for purposes of providing other types of estimates that all the requirements don't apply to. The Bureau doesn't want its form being used for other purposes. And whatever you give the consumer, whatever kind of estimate it is, if it's in writing, you need a certain disclaimer on the top of the front of the first page of the estimate, in at least 12-point font, and it's going to say, this is not your official loan estimate, and get your official loan estimate before making a choice about a loan. Third, the existing rules around collecting or imposing fees on the borrower continue to apply. So you cannot impose any fee on a borrower except for a credit report fee until you've provided the loan estimate and collected the notice of intent to proceed. Now, the notice of intent to proceed could be collected by the broker, could be collected by the creditor, but it has to be collected. And an important note about what constitutes imposing a fee on a borrower. There was a debate for a long time as to whether you had imposed a fee on a borrower if you collected their credit card information or a post-dated check, but only deposited the check or put the charge through after you'd gotten the notice of intent to proceed. And the bureaus come down clearly on that and said you cannot collect that kind of payment information in advance. So what this means is if you collect a fee for the credit report, so you get the borrower's credit card information, you charge them for a credit report, you provide the loan estimate, you get the intent to proceed. At that point, if you want to charge them for an appraisal, you have to get their credit card information again or get new authorization from them to put through a charge. It's not enough to just run the appraisal through on the credit card information you already collected. Okay, so then we move over to the right side. After, once you've provided the loan estimate, once you have the application, you must provide the loan estimate within 3 open for business days after receipt, and the tolerances apply with TILA liability. So basically, what the Bureau is trying to do is get this disclosure in the hands of borrowers earlier, and they want to make it firmer. They want to make its terms stick. So let's move on. Talk a little bit about the implications here for the wholesale lending process. As noted previously, the broker's receipt of an application triggers the obligation to provide a loan estimate within 3 general open for business days. It doesn't matter that that information, that application has not been submitted to the creditor. The clock is ticking on the broker. So if the broker provides the loan estimate, one option is for the broker to turn around, and within that 3-day period, place the loan with a creditor, and the creditor provides the loan estimate. But if the broker provides the loan estimate, then, as discussed previously, the broker has to comply with all the relevant requirements as if it were the creditor. If the creditor is unknown, then you leave the loan ID blank and the lender information blank. That's important, and I'll point it out when we get to the form. In the upper right, there's a loan ID number. The Bureau does not want the broker's loan ID number in there. That's the basis for the lender, and so it's left blank until there is a lender. If the creditor accepts a loan after the loan estimate has been provided, the creditor is bound by the tolerance limitations, notwithstanding the fact that there might be an error in what the broker disclosed, or what the broker disclosed doesn't represent the terms offered by the creditor. If the creditor accepts that loan, it's stuck with the LE until you've got a change circumstance, borrower requested change. And I have this quote here simply because sometimes people find that hard to believe that that's really what the rule says. So here's what the rule says. Even if the broker provides an erroneous disclosure, the creditor is responsible and may not issue a revised disclosure correcting the error. So the Bureau really means it, and this is what they say. Okay, so that's a little bit about the rules. Now we're going to talk about the forms a bit, and I'll be showing the forms to you in a minute. Hopefully you've already seen them, but just a few things to call out in advance. The GFE important date section is gone. The APR is de-emphasized. That was based on consumer testing showing that consumers simply do not understand what the APR is and don't know how to use it. The other FedBox disclosures are gone. There's no finance charge, there's no amount financed, there's no total of payments on the loan estimate. Those will show up again on the closing disclosure, but based on testing showing that consumers really don't use those when shopping for a loan, the CFPB basically pushed them to the back. You're going to see increased itemization of settlement charges. So the mandatory HUD roll-ups are gone. No disclosure of lender-paid broker compensation on the loan estimate. That will appear on the closing disclosure. And then a number of new disclosures, including an enhanced projected payments table, which is going to replace the payment schedule, an in 5 years disclosure, and a total interest percentage. And I'll point those out when we get to them. So here's page 1. And I think I'm going to show you 2 different versions of page 1 in just a moment. What I want you to think about, what you should think about when you're looking at page 1, this is designed to disclose one of the most complex products that will be covered by the Bureau's rule. This is a 5-1 ARM with an interest-only feature. So this triggers all sorts of additional disclosure requirements. For instance, interest rate. Can this amount increase after closing? Yes, and then you're disclosing all sorts of additional information to the right about how often it can adjust and how high it can go. Similarly, the payment can go up, and you're disclosing information about that. You get down to the projected payments table. You have 4 different rows disclosing all the different permutations, not all the changes actually. 4 rows are the maximum that this can go up to. So you're disclosing the first 3 changes, and then the last column covers the remainder of the loan term and provides a giant range. So you'll see that's years 12 through 30. You're disclosing below that estimated taxes, insurance, and assessments. And what's noteworthy here is that you are disclosing those in this case. If you look over to the right, it says in escrow, no. So this loan does not have an escrow account. You are still disclosing an estimate of taxes, insurance, and assessments. And that's because the Bureau wants the consumer to have some sense of the total cost of taking the loan. Below that, you have estimated closing costs and estimated cash to close. So this form looks like this based on the Bureau's testing. And what the Bureau's testing and the other available research out there showed was that when shopping for a loan, consumers care about basically 3 items. They care about their interest rate, they care about their payment, they care about whether those 2 things can change over the life of the loan, and they care about how much cash they have to bring to the closing table. So this was designed, the form was designed to basically give the borrower that information all on the first page. If they choose not to read anything else, they can get what they need on the first page. And, as we'll see in a minute, if you put 2 loan estimates for different loan products side by side to call out the differences between the 2. All right. The projected payments table, though, is one of the most important parts of this. As already discussed, you can itemize up to 4 separate periodic payments or range of payments. You're providing the estimate for taxes, insurance, and assessments. What you'll see here, and actually I think this will be even easier if we go to the next slide. I know it's sort of dizzying to look at all of this content, but what I want you to see here is the difference between the loan on the left, which is the 501 IO ARM we talked about before, and the form on the right, which is a 30-year fixed. The form on the left looks a lot more complicated, not as pleasant to look at. Whereas the form on the right has a lot more white space and looks more simple. And that's by design. The idea is the more complex the product, the more complex the disclosure should look. So if you're a consumer and you are comparing these 2 products, you put them side by side, it's very easy to make those comparisons. And just to talk about the projected payments table for a moment, you'll see on the right-hand side, you've got this is the 30-year fixed loan. So you have 2 columns showing payments, and the only reason there are even 2 columns is because there's mortgage insurance on this loan, and it's dropping off in year 5. So otherwise, were there not mortgage insurance, you would just have principal and interest in estimated escrow. Now here, on the right-hand side, this loan is escrowed. So you have an estimated escrow line in the projected payments table, rather than a row of zeros for estimated escrow as you do on the left. And below, in estimated taxes, insurance, and assessments, on the right-hand side, in escrow, the answer is yes to property taxes and homeowners insurance, whereas on the left, it's no to property taxes and homeowners insurance. So this form requires a lot of dynamic disclosure, where based on whether certain things are triggered, disclosures pop up or go away. There are certain circumstances where you can include text and just leave it blank if it doesn't apply, but there are other circumstances where you literally have to remove the information, and so you need systems that are capable of providing that functionality. All right, this is page 2 of the loan estimate, and this is the itemization of costs. As previously discussed, you were able to itemize origination fees and other costs. It's not mandatory to roll them up. There is a line in the upper left. You have loan costs and other costs. Loan costs on the left, other costs on the right. Below the loan cost header, you have origination charges, and below that, you'll see 1% of loan amount points, and then a dollar figure to the right. That is pre-populated text. If there are no points on this loan, and I should say no discount points, the only thing that can go in this line are points that reduce the interest rate. If you have some other kind of point, you can't disclose it here. You can't disclose it as a percentage of the loan amount, and you can't call it points. You can call it anything else you want. Below that, you can call it an origination fee, something like that, but you have to disclose it as a dollar amount and not points or a percentage of the loan amount. So if there were no discount points on this loan, you would just see a blank next to the percentage, and then the rest of the text would appear, and you'd have a blank at the dollar amount, but it would still be pre-populated text. You will not see on the loan estimate, as I mentioned earlier, lender-paid broker compensation. That's because it's not a charge to the borrower, so the Bureau decided it doesn't belong on the loan estimate. Congress did require that it be disclosed, so the Bureau put it on the closing disclosure, and I'll point it out when we get there. Finally, the requirements here around certain items on this page, have to be called text mandated by the Bureau, specifically points, as we talked about. But generally speaking, you're not required to call something any particular name. The requirements are instead that the item, you must use consistent terminology to disclose the same item throughout the process, throughout the origination process. So here, in the upper left, you have a processing fee. That's perfectly fine. You can't change its name later to an underwriting fee or something else. It has to be tracked consistently throughout the process so that it's easy for the borrower to see whether it's changed. Similarly, while you can call the fees whatever you want, you have to list them in alphabetical order. So you'll see under B on the left-hand side, services you cannot shop for, the fees are listed alphabetically, and that requirement carries throughout. And the idea there is it's going to make it easier for the borrower to locate the fee from one disclosure to the next and see whether it's changed. Below that, C, services you can shop for. And by the way, the concept of shopping we'll speak more about in just a minute. It matters for tolerances. But below that, you have certain fees that have title and a hyphen in front of them. Essentially, any charge that's related to title insurance or the closing of the loan has to be disclosed with title hyphen in front of it, and then it's alphabetical after that. Moving over to the right-hand side and other costs, you have a lot of hard-coded text here. So, for instance, under prepaids, your homeowner's insurance premium is filled out, whereas there's no mortgage insurance on this loan, so you can see it's just blank, but you're still disclosing the text. All right, so then we move down, and obviously I'm not going to cover everything here because we have limited time. I just want to call out what I think are the most important things. Down on the right-hand side under other costs, you go down to J, total closing costs, and you come to lender credits. So what's important here is lender credits on the loan estimate must be disclosed as a lump sum. So you could not, for instance, if you look over on the left-hand side under B, you see appraisal fee. If the lender was going to pay for this appraisal fee with a credit, what you would do is disclose it, disclose the appraisal fee over there, 305, and you'd include an offsetting 305 lender credit here. You can't put it up there right next to the appraisal fee to show the borrower that it's being paid for by the lender. So that's something that's going to have to be explained. So I just wanted to call that out. You have calculating cash to close, which basically takes the total closing costs, makes adjustment for down payments and deposits, seller credits, and arrives ultimately at the estimated cash to close that appears on page 1. So all of this is designed to feed one giant calculation that yields an estimated cash to close figure telling the borrower how much they should expect to bring to the closing table. At the bottom of the page, you see two tables. On the left, the adjustable payment table. On the right, the adjustable interest rate table. And the adjustable payment table, well, I'll start with the adjustable interest rate table, provides certain information about adjustable rate loans, the index and margin, caps and floors on interest rate adjustments, frequency of changes, and so forth. On the left-hand side, you have the adjustable payment table. This applies when you have changes to payments that are not the result of a change in the interest rate. So that appears here because this is page 2 for the 5-1 IO ARM. So we've got payments being adjusted, the rate being adjusted because of the ARM feature, and you've got payments being adjusted not just because of the ARM, but because of the IO. So you're disclosing both of them. What's different about these, though, is that if they don't apply, they have to go away. So you can't just include the table and leave the information blank. Your system has to actually remove the table entirely from the disclosure, and then this is just white space right here. All right. So this is page 3, and I'll just make a few quick notes here about page 3. At the top, you have the lender information along with NMLS IDs and contact information. If this is being provided by a broker and the lender is not yet known, you leave that blank. On the right-hand side, you have the mortgage broker information, and that's left blank if there is no broker. Below that, you have the comparisons. And here, first you have in 5 years. And what this is, it is what it says right here. You're disclosing the total amount of principal paid off in the first 5 years on the bottom. That's the 0, because this is an IO that resets at 5 years, so they paid off no principal in the first 5 years. But above that, you have the total paid in principal, interest, mortgage insurance, and loan costs in the first 5 years. And the idea here is it's just intended to be a snapshot based around the notion that the average life of a loan is 5 years, and that this provides more useful information to the borrower than a total of payments or other disclosure that assumes the loan's going to run the full term. Below that, you have the annual percentage rate at last. And what's new here is the same annual percentage rate it's always been. Your systems don't need to change. The added information on the right-hand side, this is not your interest rate, which should at least hopefully help borrowers understand that that is not their interest rate, even if they still don't understand what the APR actually is. Below that, you have the TIP, total interest percentage. This was added by Congress in the Dodd-Frank Act. And it is the total amount of interest that the consumer will pay over the loan term as a percentage of their loan amount. So here, and this number, you'll need to be prepared to explain this number to borrowers because it is shockingly high, even if there's really nothing wrong with the loan. It's not unlike the total of payments disclosure, just in that looking at the actual figure can be somewhat shocking. Here, the consumer's total interest over the life of their loan will be 81% of the loan amount. All right, below that, very quickly, you just have some other disclosures that are required by law that the Bureau has inserted here. I'll just call out the appraisal disclosure. This is the ACOA appraisal disclosure. It's also the HPML appraisal disclosure. If you provide it here, you do not need to give a separate piece of paper. So that's one piece of paper off the list. At the bottom, the servicing disclosure. This is a servicing transfer disclosure. If you provide it here, you don't need to give it separately. At the bottom, you have the receipt line. That is optional. You do not have to include it. Okay, and I do want to leave time for questions, so I'll pick up the pace just a bit. You have the same 3 tolerance categories that exist today: 0 tolerance, 10% aggregate tolerance, and no tolerance. And here's just a description of what appears where. A couple of things I just want to call out that are important. Lender credits are subject to the 0 tolerance. That is the case today. The Bureau actually, in its supervisory highlights last week, announced a finding against an unnamed institution for changing the lender credits without a change circumstance. So those are 0. Importantly, what is also 0, if you look in the third box under 0 tolerance, are fees paid to an affiliate of the creditor or the mortgage broker. It's not the real estate broker, it's the mortgage broker. So if the charge goes to the affiliate, it's subject to 0 tolerance. 10% aggregate tolerance otherwise remains the same. Everything else is subject to best information reasonably available. I just like to remind people that doesn't mean it can be anything. You actually need a basis for the disclosure, but the standard is much looser, best information reasonably available. Okay. So shopping, I mentioned this before on the page 2 of the loan estimate. You saw the concept of services you can shop for, services you can't shop for. That matters for the tolerances. If you do not permit shopping, if you mandate that the borrower use a particular provider, then the 0 tolerance applies. If you permit the shopping, but the borrower doesn't, so you give them a list of service providers and they pick somebody off of your list, you've allowed them to shop, but they didn't. They took one of your people. 10% tolerance applies. Finally, if you permit them to shop and they do select their own provider, they go out and pick somebody who's not on your list, who meets your requirements, they're properly licensed, then tolerances do not apply. You're not subject to the 10% tolerance. You're not subject to the 0 tolerance. So how do you permit a consumer to shop? You have to allow them to select the provider, subject to reasonable requirements. The loan estimate must identify the services for which the consumer may shop. We already saw that. And then finally, you provide a written list of providers that identifies at least one available provider for each service and informs the consumer they may choose a different provider. And the Bureau provides a form for that. It's an optional form, but it's a form you can use. All right, affiliated charges, as I already said, these are subject to the 0 tolerance. So it's effectively the same as if the creditor itself was providing the disclosure for its own fee. For that reason, it's much harder to show changed circumstances. If you are a creditor or broker and your affiliate's providing the service, you actually need to know if their estimated cost was the basis for the estimate you originally disclosed and something changed. It's not enough to just say it changed because you're relying on a third party. You actually need to know why and be able to show that there was a changed circumstance. Okay, redisclosure and resetting the tolerances. Revised loan estimate must be provided within 3 open for business days, these are the general business days, of receiving information sufficient to establish that a change is permitted. And you have the same general exceptions for changed circumstances, consumer requested change, you have the rate lock, you have the expiration of the loan estimate after the mandatory 10-day period, and you have construction loans that are going to close more than 60 days after you're disclosing. Importantly, the increase above the tolerance must be caused by whatever your exception is. So the fact that you have a consumer requested change that increases one fee or one aspect of the loan doesn't mean that you can increase everything else. There actually has to be a causal relationship between the two. Okay. The changed circumstances definitions have stayed the same, so I won't belabor them here, but they're the same ones you work with today. Similarly, here are the other exceptions. Something important to note is that interest rate dependent charges, so discount points and other creditor or mortgage broker charges or credits change because the rate was not locked. Then when you lock the rate, it's mandatory to provide a revised loan estimate within 3 business days. You may have heard that the Bureau adopted a same business day requirement for rate locks, but in January they actually rolled that back and it's the same 3 business days as it is for everything else. Okay, resetting the 10% aggregate tolerance. This is a little complicated. I'll try and describe it clearly but quickly. If you have an increase in the 10% aggregate tolerance, so those are all the charges that fall within that bucket, and it increases that lump sum by less than 10%, even though it's a changed circumstance, that doesn't mean you can reset the tolerances by redisclosing. Instead, you have to wait until you have multiple changed circumstances that cumulatively add up to more than 10%. At that point, you can redisclose within 3 business days of the last change and reset the tolerances. You are permitted to redisclose for the others that don't reset the tolerances, but importantly, you'll have to disregard those disclosures when calculating tolerance compliance. So that's tricky. Okay, the closing disclosure. This part will go much faster because, as you'll see, most of the closing disclosure is designed to look a lot like the loan estimate, particularly page 1. So page 1 of the loan estimate, the closing disclosure is designed so that it can be put side by side with the loan estimate, and the borrower can easily see what changed. The borrower could do the same thing with revised loan estimate, compare them side by side with the new loan estimate. That was intentional by the Bureau. By the way, I promised I would show you where the loan ID number was. I forgot to do it on the loan estimate, but I'll show you where it is on the closing disclosure. It's in the upper right. You'll see a loan ID field, and it's in the same general place on page 1 of the LE. That's what you would leave blank if you're disclosing this and you're a broker and you don't know who the lender is yet. Okay. Page 2. This looks a lot different than page 2 of the loan estimate, but the same basic organization. You have loan costs, you have other costs, you have the same A, B, C, D, and so forth. It's just stacked instead of side by side. And the reason it's stacked is because the Bureau wanted to make room for the borrower paid and seller paid columns to have at closing and before closing columns with subcolumns within them. And you've got paid by others to the right. So the idea here is this won't be filled out with POC and the margins or anything like that. You'll clearly be able to distinguish between what's paid at closing and what's not. Items paid for by others will include items paid for by the lender. So you'll disclose them in this column. If you were disclosing loan originator compensation paid by the creditor, that's where it's going to go on this form, is in the paid by others column. All right. The other thing to notice here is that on the loan estimate, if you were paying attention, you would have seen that all of the amounts disclosed were rounded. And the reason for that is it's designed to be an estimate, not a down to the penny. But here, this is the closing disclosure, so it's designed to be more precise, and so you are disclosing cents. All the way down at the bottom in very small type, the very last line says lender credits. While specific lender credits that pay for particular charges are going to go in the paid by others column. So for instance, you'll see that here the lender paid for the appraisal fee. So its appraisal fee go all the way over 405 in the paid by others column. If you had lender credits that were not specific to a particular charge, you just disclose them down at the bottom. Okay, page 3. You have calculating cash to close at the top, and here you're comparing the last loan estimate that was provided to the disclosures on this form, and then you're answering the question, did this change, yes or no? If it changes, then that triggers these, see total loan costs, for instance. It triggers cross-references to other parts of the form where the consumer can see the specific information about what changed. Below that, you have the summaries of transaction, very similar to what's on the HUD-1 today. I won't spend any time on that right now. And then you have pages 4 and 5. This is where the Bureau tried to cram in as many additional disclosures as possible into as little space as possible. So most of them don't warrant discussion. You'll just notice this white space at the bottom of the page. That's where, if you had to disclose the adjustable payment table or the adjustable interest rate table, they would go. In this case, this is page 4 for a closing disclosure of the 30-year fixed rate loan. So you have no adjustable payments and no adjustable interest rate. Last page. In the upper left, you have the FedBox disclosures and the total interest percentage. On the right, you have the appraisal disclosure and some other miscellaneous disclosures. Below that, you have a contact information table where you're providing information about the lender and the mortgage broker, as well as the real estate brokers, if any, and the settlement agent. And then finally, again, you have the confirm receipt signature, which is optional. Okay, so now to talk just a bit about the rules underlying the disclosure. The creditor or the settlement agent may provide the closing disclosure, but the creditor is ultimately liable. However, the seller's closing disclosure is the responsibility of the settlement agent. You must deliver, or the creditor really, must deliver the, excuse me, the initial closing disclosure at least 3 specific business days before consummation. So that's the rescission definition of business days. You're talking about any day other than a Sunday or a federal public holiday. If it's in person, then you can hand deliver it to them 3 business days. Otherwise, you have to rely on a mailbox rule. And that's whether you're emailing it to them, and you have to have e-sign consent before you email it. But whether you're emailing it to them or, excuse me, you're putting it in the mail, it's a 3 business day mailbox rule, which means it's going to need to go out 6 business days before consummation. Existing requirement, the borrower can 1 business day before request a copy. That's in RESPA today. They can do that. And then you can revise the CDs at consummation. The only things that trigger a new 3-day waiting period are an increase in the APR by more than 1/8 or 1/4. It's the rule today. A change in the loan product, and that's very narrowly defined. It means you're changing something from a fixed to a variable to a fixed. You're adding an interest-only or negative amortization feature. Those things will require a new 3-day period or the addition of a prepayment penalty. Otherwise, you're still subject to tolerances, but otherwise you can just redisclose on the CD. Okay, and this essentially covers what was shown graphically. On the other, I've talked to you about the mailbox rule and the need for e-sign consent. So I'll move past that. We've talked about redisclosure. Just a note, because there's a lot of confusion about this. Again, it's an increase in the APR by more than 1/8 or 1/4. Decreases in the APR will almost never result in a new 3-day period. Okay. There are some issues around resetting the tolerances using the closing disclosure. Generally speaking, you can do it. Once you provide the closing disclosure, you cannot provide another loan estimate. So it's not like today where you might provide a GFE at closing that matches up with the HUD-1. You can't do that anymore. Once the closing disclosure is provided, no more loan estimates. That means you can disclose change circumstances and reset the tolerances using the closing disclosure. The only issue is if the closing date gets pushed significantly after the closing disclosure is issued. In that case, if it gets pushed by a week or two and you've got a lot that's going to expire, there's no ability under the rule to reset the tolerances by issuing a new closing disclosure, which means you could not charge the borrower a rate lock fee under the rule. The Bureau recognizes this is a problem, and so folks are waiting to see whether they're going to fix it or not. Okay, after closing, you're permitted to cure tolerance violations for up to 60 days by refunding the excess amount and providing a corrected closing disclosure. You can cure other amounts, other charges that were paid by the borrower at closing within 30 days of learning that it's inaccurate. So that would be, for instance, if excessive recording fees were collected, you can refund the amount and issue a new closing disclosure. And then non-numeric errors must be corrected within 60 days. That would be where you disclose the amounts correctly, but maybe you identify the wrong payee. Okay, and I took a bit longer than I was hoping to do, but hopefully there's time for a question or two before we wrap up.
Sure, I'm sure. Thank you so much, Ben. We can get a couple questions. We have an awful lot of questions that have come through. We are going to send out an FAQ afterwards, probably within a week. You can just see on this slide to view our first webinar. You can go to our website, and that tells you where. We have had a lot of questions about getting the presentation. This is going to be sent out to everyone who has attended, and it will also be posted on our website. So let's get to a couple of questions. The first one here that we got, does the TIP or total interest percentage include interim initial interest?
Okay, if by interim initial interest, if I understand that to be, prepaid interest for the accrued for the period prior to the first scheduled periodic payment, if I'm right about that, then the answer is yes, the TIP would include that amount.
Okay, great. How are tolerance variations calculated?
Right. So it really depends on which tolerance bucket you're in. If it's zero tolerance, then it's fee by fee. So if we're talking about your origination fee, it's subject to a zero tolerance. You're just going to look at not all the fees in the zero tolerance bucket. You're going to look at each specific fee and compare it. However, excuse me, in the 10% tolerance bucket, it's an aggregate tolerance, so you're going to be comparing the totals. One important note on this is that the Bureau has said that if you disclose something initially that's in the 10% tolerance bucket, and you don't wind up charging that fee, you remove it for purposes of calculating the 10% tolerance. And that's designed to take away an incentive to basically disclose additional charges up front in order to inflate the size of the 10% tolerance bucket to give you more room for adjustments down the line.
Okay, great. We'll go with one more question because there's a couple parts to this last question. And then again, we will get everyone's questions answered. But please explain timing and when does the 3-day wait period start? Do purchase loans now have a 3-day right of rescission? And do the borrowers have to sign the closing disclosure 3 days prior to closing?
Got it. Okay, there are a couple of different questions in there. So the first, and I'll sort of handle them sequentially. The first is that you have to provide the new closing disclosure 3 business days. It has to be received by the borrower 3 business days before consummation. And again, that's the date they become legally obligated, generally going to be the signing date. You can revise that disclosure and reissue it at the actual consummation. Whether the borrower signs the disclosure or not is not required by the rule. Could be an investor requirement. You may want to have them sign it for your own purposes, but the rule doesn't require you to have them sign the form. The other question in there was, and that 3-day period, that 3 days between when you're providing the closing disclosure and consummation is mandatory for all loans, not just purchase loans or refi loans. Then the question was about rescission. The rescission right is unchanged except that the closing disclosure is a material disclosure or contains the material disclosures, and the Bureau has said that they must be provided consistent with the timing requirements in order to avoid triggering an extended rescission period. So what that means is if you fail to provide the initial closing disclosure 3 business days before consummation, then other than delaying the consummation, there's really no way to cure that. So if you close a loan where the closing disclosure was not provided timely, then you're going to have an extended rescission period. But regardless, for a loan that is subject to rescission, you're going to have 3 days before consummation and then the rescission period 3 days after that.
Great. Thank you so much, Ben. I think we do have to break at this point. I want to thank you for your time today, and I would like to send it back to Carl to wrap things up.
Thank you very much, Ellen, and thank you very much, Ben. We were so lucky to have Ben on our call today. As you can see, a lot of you are somewhat knowledgeable on all these changes that are going to be taking place, and it's our job as a lender to be able to provide as much education as possible. So thank you very much, Ben. Just a quick note, Ben will be back to us on June 4th, and the topic there will be FAQs and workflow. But again, we're going to be doing these webinars every month. Our next webinar for next month is April 16th, so please, as on your screen right now, sign up as soon as possible because we do have limited space for these next webinars. But I would like to thank everyone on this call for attending today, and thank you very much. Have a terrific day, everyone. Bye-bye.